The HDFC Bank stock has fallen from a high of 1650 rupees on the day post the merger announcement to a low of 1350. Actually, right now it is even lower than the pre-merger price, which was around 1450. Now, in the month of April, it appears that there has been around $3 billion of FIIs selling in the stock. Of course, they have sold emerging markets in general and India in particular, but HDFC Bank, $3 billion. Investor concerns: one, the bank's pre-provisioning operating profit rose in just single digits in Q4. Two, the merger will hurt return on assets and return on equity for at least 4 to 6 quarters. Three, the merger will also take away the bank's energy for the next few quarters and it won't be able to concentrate on growth. Four, ICICI is available at nearly the same valuation without the concerns of merger. These are some of the concerns. Today I have with me someone who continues to hold a bullish view, and maybe he will be able to answer some of the concerns. I have with me Suresh Ganapathy, banking analyst of Macquarie Capital Securities. Good morning, Suresh. Pleasure having you with us. Well, first, what is on everyone's lips? Pre-operating profit, single digits. How would you counter that worry?
Yeah, the critical question, Lata, is how long is this going to continue? Because what has happened here is that it is not that the bank deliberately went and chased the 21% loan growth, right? So there were enough corporate opportunities which were there in the market in the fourth quarter, and that fitted the criteria of about 2% ROA and 20% ROE. So as long as it fits my criteria, it's okay, I take that business and later on leverage on that particular business. So what exactly happens is, while focusing excessively on PPOP, we also miss the point that these loans come inherently with extremely low or nil credit cost. So at an ROA level, and in fact more at an ROE level, because the RWA density is very low in case of these corporate loans, it can definitely be in line with the overall company's ROA target of 20%. So that is nothing wrong in my view in the near term. Longer term, obviously, as and when the share of corporate loans come down and retail loan picks up, this PPOP anomaly should get corrected. What is more important for an investor is profits, and that they are not compromising, and the quality continues to be pretty good. And that's why we have a different view on the stock at this point in time.
Okay, got that. So even if the corporate loans are not very high on the yield, the fact that they will engender less NPA will mean less provisions to be kept, and so overall it's a profitable venture at the bottom line. The other charge is that after the merger, it becomes an 18 lakh crore giant. Will it be able to engender the same 20% growth?
So that is another big concern in the minds of investors. So now this is how we look at it. One is a very short-term myopic view that some people might be willing to take, and one is a long-term view. Now let's look at the fact that in the last 5 years, any bank, be it ICICI or Axis or SBI for that matter, or Kotak, all of them have grown their loan book predominantly driven by mortgages, right? So mortgages becomes the most important portfolio for any bank in the system because it's actually the best performing portfolio in terms of growth. Now, HDFC Bank grew 20% even without mortgages. Now, the critical call here, Lata, is how long can you sustain it? So you can take a near-term view saying that the next 2 years growth will get affected because obviously you are taking such a large balance sheet, and therefore to that extent the base is going to work adversely against you. But let's take a 10-year view. On a 10-year perspective, or for that matter on a 5-year perspective, eventually all analysts will downgrade the growth for HDFC Bank because HDFC cannot grow at 20% without having mortgages in their portfolio. So what exactly happens is, having mortgages means you can have a 10-year growth of about 17-18% of loan growth, which otherwise everybody would have downgraded 5 years down the line to 15-16% because of not having mortgages. That's the significant delta that the market is missing at this point in time.
Okay, fair point. Actually, when I interviewed Deepak Parekh, his point was the same. They have the retail loan book without mortgages has to be renewed in 14 months. That is the average length of the loan. So if you have to grow at 20%, you have to replace that 14% and grow 20%. With this mortgages, the length of the loan, retail loan, becomes 6 to 8 years. So yes, that perhaps will be a later realization. Now, what is the answer to those who believe that anyway ICICI is giving you a higher pre-operating profit, pre-provisioning operating profit, and ROA not bad? So how do you answer that? By both?
Look, yes, of course, in the near term, there is more merit to perhaps buy ICICI because there is less of noise there. Let me put it this way: that there is MSCI index rebalances and Nifty rebalances. Then you will also have other challenges with respect to the approvals from Reserve Bank of India. What shape and size and format the merger takes. So those kind of uncertainties are there, and people can argue that we just don't want to live through this uncertainty and move towards ICICI Bank. But today, let's put it this way: that both HDFC and ICICI are trading at the same valuation of about 2.3, 2.4, which is what very clearly we have highlighted on the note on a core price to book basis. At the same valuation, I do believe that HDFC Bank still structurally has a 20 to 30 basis point higher ROA than ICICI Bank. So to that extent, you are getting into a stock which fundamentally has a higher ROA than ICICI, for that matter, any of the other banks in the system, but available at the same valuation. And therefore, I'm still willing to place a bet on HDFC Bank over the longer term.
Fair point. Okay, now for HDFC Bank, the immediate return on assets and return on equity can be compromised because they have to keep a higher CRR and higher SLR and also give more priority sector loans, especially agriculture and SME, which they have not been doing, especially agriculture, which is not always rewarding. So for the next 3-4 quarters, at least you can concentrate on someone else or buy it after 3-4 quarters.
Yeah, so from a timing perspective, yes, one can always time it. It's very difficult to time the market, Lata, but yeah, maybe one can argue that another 2-3 quarters, because I do believe that if PPOP growth is the singular metric that the market is excessively focused on, I do believe that the PPOP growth at best can pick up only from September quarter. So in again, June quarter also, you're not going to see very accusing numbers, in my opinion, from HDFC Bank on the PPOP front. So a couple of quarters, obviously, there can be some underperformance in the name.
Okay, couple of. I wanted to specifically ask you that Deepak Parekh himself said that even if we don't get any SOPs or any time for the CRR, SLR maintenance, we will at the most take 4 quarters, at the most 1 year to get back to the old ROE. Fair time analysis by Mr. Parekh, you think?
No, it will take some more time. My view is at least it will take 2 to 3 years to get back. Look at it in this way, right, Lata? Your ROE today is 16%, right? And you are expecting it to touch about 18% in the next couple of years. So the reality is that the ROE will be more closer towards 15-16%, right? So it's going to be a 200-300 basis points lower. My opinion, to go back to the earlier ROE, whatever is the timeline and projections that analysts have today on a standalone basis, everything gets pushed out at least by 8 quarters. My opinion is 8 to 12 quarters is the range that I will take.
Okay. All right. Now, the other complaint, which anyway, I'm finding difficult to buy, when they are concentrating on merger, they will not be able to concentrate on growth. Is that a fair charge?
I don't think so, because you have to look at it in this way that maybe when the actual merger happens, there are some integration pains in the near term, but the bank has added 750 branches in the last 12 months. They're growing very aggressively. It's business as usual for all the employees of HDFC Bank. And also note that one interesting part about the merger is there is no product overlap. So let's put it this way, that HDFC is also doing CASA, bank is also doing CASA, or for that matter, HDFC is doing credit cards. They can't do, I'm just hypothetically assuming in a bank-to-bank merger, then there is an overlap, and then there is a worry of job losses and redundancy of roles. The entire HDFC Bank is not going to lose any particular role or any particular incentive in the overall scheme of things. So it's business as usual for them. On the contrary, there should be even more motivation, because you now have a core product of mortgages which you can cross-sell to your customers. Let's assume earlier, if HDFC Bank was going and selling a corporate loan to a particular corporate, they couldn't have packaged a mortgage deal along with that, because that was obviously done by HDFC Limited. Now you have relationship managers who can go and pitch for that business and further scale up the business. So it's like an amazing opportunity for all of them actually to have such an important product portfolio, in your overall scheme of things.
But you don't think that as it is, they could have done it, no? I mean, if not sell mortgages to their corporate customers, they could have, they anyway had a group companies, customers. They could have sold the CASA and other products to them.
But CASA and all was always being sold. That is not a problem. The real problem was ability to sell mortgages. And remember, it's the most important portfolio. And also HDFC was largely bank was doing confined to the branches where HDFC Limited where they had about 700 odd branches. It was not done across 6,000, 7,000 odd branches, and it's not a primary product for them. So they could never push it. And they were also constrained by the ability of HDFC Limited to do mortgages. I mean, I can grow at 50%, but Limited can never grow at 50%, right? So therefore, they were constrained by the Limited's ability to do mortgages.
Okay, just a final word on this MSCI rebalancing. Your latest note points out that now there are about 13% space opening up for FIIs. Yeah. So there is a very good chance that if one more percentage point of FII holding reduces, then it may get included in the MSCI.
Yeah, so that's a good thing if it were to happen. But the best part, or rather the worst part about that is that it becomes non-event, right? So the way it works is that though it gets included in MSCI, but there is a deletion coming out because of HDFC Limited.
Yes, of course.
So this on a combined basis just replaces that deletion. So there is no incremental selling which will happen because of that.
It is not there, no. But incremental sale is not there. Incremental sale is not there.
So to that extent, it is positive, but incremental buying is also not there. So just to clarify, incremental buying will also not be there because this will be mere substitution of HDFC Limited, which is getting deleted once the MSCI inclusion happens. For it to actually engender a buying, it needs a free float inclusion factor of 1 time. For that, the foreign holding has to dip down to 55%. God forbid, I don't think that should happen for the stock.
No, actually, just a word more on that point. You know, for the longest time, the ADR used to trade at a premium, and that FII segment itself used to trade at a premium in India because it was always at 75% or 74% to be precise.
Correct.
But now there is enough space. Is that a worry, or would you attribute it to, just EM and India selling by foreign funds because of whatever, dollar index at 101, etc., etc.?
So that obviously is one of the reasons. At the end of the day, if you look at it structurally or logically speaking, the ADRs should be trading at a slightly higher premium compared to the local stock because there is a tax arbitrage, right? So there is no long-term, short-term capital gains tax in an ADR compared to the local stock. So to that extent, obviously, maybe an FI would prefer to trade through the ADR. But also the problem here is that the premium is also a function of the availability of the local stock. Now, the fact that the local stock is already available because of the selling, and of course further the headroom will open post the merger. To that extent, there is a merit to argue that the ADR premiums will sustain or will sustainably come down and settle at lower levels. Interesting part is it went into discount. I think that is obviously unsustainable, and I think some element of premium will be there, but the 15 or 20% premium that we saw earlier, Lata, that is going to be a bit difficult to come back anytime in the near future.
Fair point. Okay, I just want to wind up this conversation with the latest note you have written on Reserve Bank's persistent effort to harmonize the rules between banks and very large, or what they call upper layer NBFCs. You are not ending the note with any advice in terms of investors. It's a very good note in terms of understanding. But what is your advice, therefore? Large NBFCs to be avoided?
No, okay, so, it's going to be very tricky to decide. So for example, let me put it this way, that as long as you're small, like for example, Chola is still small, there is obviously a market that they can cater to and still generate that supernormal returns. What we're arguing here is that this is more of a utopian concept, or finally where this end game is going to be. What we're arguing is at some point in time, the size will act like biggest hindrance for you to grow and grow profitably. As simple as that. No, whether that comes at a 2 lakh crore balance sheet, 3 lakh crore balance sheet, we don't know. But definitely the number could be, say, hypothetically speaking, about 2 lakh crore, right? So that's necessarily the end game. And also the reason why it doesn't necessarily give a conclusion here, Lata, is that the eventual game is going to be decided by the Reserve Bank of India. So the RBI is very clearly telling here is that I want to kill all the arbitrages which is there between the NBFCs and the banks, and the massive amount of failures which have happened in the banking and the NBFC space. We have been covering this sector for 20 years. Never ever before we have seen such large failures in such a massive scale happening in the entire Indian financial system, right? So the Reserve Bank of India is really worried, and therefore they want to really ensure that the system is safeguarded, and the health of the system is far more important. important. And therefore, the licensing regime is going to be a bit tricky. So if I'm saying large NBFCs have to be converted to a bank, then they will have to give licenses to them, and they don't want to give licenses to corporate houses. So there is a very fine balance that everybody will have to tread. Going forward, depending upon how the regulatory framework evolves.
Okay, we'll have to leave it at that. Thank you very much indeed for joining us, Suresh. Yes, there is, for the large NBFCs, you can become banks, but what do you do with corporate-owned large NBFCs? For them, it is a no-go or a no-show. We have to wrap up on this note, but keep your eye fixed on the screen. We're getting the Nestle numbers, and the profit is below the CNBC-TV18 poll, 625. As you can see, compared to that, we'll have to see whether raw material costs have caught up. It doesn't look like ad spends, but it could be raw material costs. It's a very interesting set of numbers. Keep your eyes fixed on the screen. We are back in a jiffy with Chartbusters and much more on Nestle India.